Hi everyone. Mainly because it's the summer, I don't really have that much to do. I've been meaning to do this for a while, on top of the fact that I'm no longer competing in debate anymore, so I've got a lot of free time. I was looking to create a new YouTube channel that would allow for me to explain to my friends and give them various investment advice, but to also share some of the knowledge that I've amassed throughout time through the various reading that I've done. So I decided that I would start a new series of videos starting with 10 common Wall Street misconceptions. And this is the first video, so feel free to leave comments, let me know what you think of them so far. But this specific Wall Street misconception is that the market is not for professionals only. And I broke this down into two components. First, that professionals aren't actually really smarter than you or outperforming you. And secondly, that the market is not too risky for an individual to take on by themselves. But let's start with this first belief that professionals are so smart and they've got the inside scoop on what's going to go up next. But when we actually look at their performance and break down all of the loopholes that they have to worry about as being a mutual fund manager or even being a certified financial planner, we can recognize that they're usually super diversified, generally because they own billions of dollars in assets under management, and they actually have legal caps as to how much of a business that they're allowed to earn. They're also expected to earn consistent profits each year in order to appease short-term investors. So they would much rather churn out a consistent 6 or 7% return, even if that means that over the long term, while their returns might be more volatile, that they might end up with a larger return rate in the end. But because they know that their performance is always being judged year after year after year, that they have to make sure that they stick with those stocks that are going to earn them that rate of consistency. Additionally, they're usually forced to stick with indexes like the S&P 500, which is responsible for about 75% of all of the money that gets traded. If they make a bad pick, they usually lose their jobs, or they might only gain a few extra percentage points if they're right. But the average Wall Street professional really does not have any incentive to earn more than the industry average, given that they usually get some kind of pre-approved list that's usually handed down to them from upper management. That's a handful of maybe 200 or 300 stocks that have been rubber stamped as being the pre-approved list that they're allowed to trade from, what their investment firm believes is going to make people money. And as long as they stick to that list, they'll continue to make hundreds of thousands of dollars a year. But if they stray away from the list, then they could lose their entire livelihood because they had a really good feeling about Green Mountain coffee roasters that didn't pan out. But when we actually look at all of these loopholes that professionals have to worry about, we can look to 2015 data from the Motley Fool, which found that because of their excessive annual fees and poor execution, that approximately 80% of mutual funds underperform the stock market's return in a typical year. And that on average, they usually earn 2% less than the market average. Because whenever you consult a professional, that you have to worry about their commission fees, their front load fees, their various management fees that they work into the equation to make sure that they make money, that once you factor in all those fees into account, that about 80% of the time you actually would have ended up with more money if you had just put all that money in the S&P 500, which is a list of 50 different industries that are basically the top 10 businesses in terms of size in each industry, and just bought and held them over the long term versus ever giving your money to a professional. So professionals are not actually smarter than you. And most of the time, they're more worried about the safety and the security of their position, that they're not actually going to be looking for individual stocks that'll make you more money. And even if they do find them, they don't think that it's going to be worth risking their entire livelihood in order to get you that additional 2 or 3%. But let's also look to the argument that the market is too risky for the individual to take on their own. Well, when we actually look at historical data from the stock market, in particular the Great Depression, we can recognize that the stock market actually isn't as scary of a place to put your money as long as you're looking to keep it in the long term. Long term, I would define as at least a decade, but in this particular scenario, we're going to be talking about 25 years. That when we look at the impact that dividends in particular, which for those of you who don't know, dividends are actually checks that companies send you each quarter that are basically a share of profit. That if you own, for example, 1% of McDonald's, that in theory you should have a legal claim to 1% of McDonald's profits. So whenever McDonald's makes a profit, they decide what percentage of their profits they're going to pay back out to their investors, what's referred to as the payout ratio. And based off of whatever they establish that payout ratio to be, it determines the amount of money that you receive back in cash on hand. And according to empirical data that was compiled in Dividend Investing for Dummies, they found that about 48% of the market's total return amounted to just dividend payments since the year 1900, which demonstrates that dividends have played almost an equal part in making you money than in share prices going up or down. However, we also can demonstrate the positive impact that dividends have had on total return over time when we look at the worst economic period our country's ever faced. The Great Depression started with the stock market crash of 1929. For this analysis, we refer to the Ibbotson SBBI 2014 Classic Yearbook, which provides historical market price and total return data. In all cases, we are referring to large company stock returns, which for the time period studied reflects the S&P 90 index, which was actually the predecessor to the S&P 500 index. From the stock market high in August 1929 to the low in February 1933, the market declined more than 85%, and it took more than 25 years, or from 1929 to 1954, on a price return basis for the market to get back to break even, where it was trading before the crash of 1929. However, based on total return data, or capital gains plus distributions or dividends for that period, the results were quite different. According to the same Ibbotson total return data, an investor would have reached break-even by 1944, a full 10 years earlier, when taking into account dividends and dividend reinvestment. During the 25-year period in which it took prices to get back to break-even, an investor who invested $100,000 and reinvested the dividends would have seen his or her portfolio grow to $431,000 pre-tax, or a return of 331%, roughly a 6.1% compounded annual growth rate. This is despite the fact that dividends declined materially from the market peak in 1929 through the trough in 1933. In the worst time window in history, markets still averaged over a 6% annual return rate. But yet, so many people feel comfortable keeping their money in low yield bonds, in annuities, in municipal bond funds, various investment instruments that are actually underperforming the worst market time window in our entire market's history. That's unfathomable. And if we really want to develop an understanding of what it will take for us to achieve our financial goals, we need to be able to dispel a lot of the fictions that currently exist in the financial arena. This first one, or this particular one of markets only being for professionals, is really the first thing that we needed to address by recognizing that professionals aren't necessarily smarter than you, and that the market is not too risky for the individual to take on. Thank you again for watching, and hopefully you enjoyed this video and the future videos to come. Thank you.